So ready for the class or spring break? Spring break. Okay. We try to wrap up the class soon so that we get ready for the spring break. So in the last class, we basically started talking about bond, right? So we know that it's a kind of debt instrument corporations issue to get some capital, right? So we also talked about how to do the valuation. And some of you got confused like how to calculate the coupon payment for the bond. So just to rewrite the formula, coupon payment for the bond is basically coupon periodic rate times face value, not price, face value. And if we revisit the very basic structure of the bond, today we pay the price and buy the bond, right? And each period, as an investors, we are entitled the coupon. At expiration, we entitle coupon plus the face value. Right? One of the assumptions when you talk about bond is like we buy today, hold most of the cases until maturity. Okay. What if we buy today, 6 months or 1 year later, we decided we want to sell the bond, we want to liquidate the position? What should we do? We buy today, maybe let's say here, we are suffering through liquidity crisis, we need the money, we want to sell out the bond. What should we do? Financial analysts can make the evaluation or valuation. They cannot trade for you, right? They can give you the fair value of the bond, right? We have to literally make the trader, we have to find the trader, right? But that's not the concern. The concern is if you want to make the trade, how much you're gonna get here? Are we supposed to get the face value here? Are we supposed to get the price we paid here? How much you are supposed to get here? That's the questions. What do you think? How much you're supposed to get? Face value or the price you paid at day zero? What is your intuition? Like if you brainstorm, what do you think?
You just get like the remaining amount, like face value and the payments you haven't done.
No. So basically, corporate bonds trade like stocks. Secondary market trade very frequently like stocks. But the price at which corporate bonds are trading on the secondary market depends on interest rate. Interest rate. So like the way we calculate the price here based on present value of expected cash flow, right? And we took the existing on spot market interest rate to discount it, right? If you can remember from the last class, If you can remember the last class, the issuer will give you coupon rate, face value, maturity, right? You have to think for a similar investment, what is the appropriate market rate, discount, and get the price here, right? After you buy the bond, the bond started trading on the market. Now the price will be based on if market interest rate changes. Price is always present value of all the expected cash flow, discounted value of all the expected cash flow. As we keep moving on the timeline, if interest rate is changing, price will be also changing. Simple thing. If you keep move from here to here, all the expected cash flow, present value of all the expected cash flow. Move from here to here, present value of all the expected cash flow. That's it. If interest rate doesn't move, doesn't change, price will be the same. But if interest rate fluctuates, price can go up, price can go down, right? Depending on the fluctuations. So if you buy a bond and if you want to trade, due to interest rate fluctuations, there are two types of risk. The first risk is price risk. Why there is price risk? Because if you want to trade the bond price will fluctuate depending on market interest rate fluctuations. And the risk is if interest rate goes up, price will go down, you will lose your investments. That is the price risk. Makes sense so far? So, change in price due to the change in interest rate, and we are only concerned when interest rate goes up and our price goes down. What if you buy the bond here, hold it until maturity, no price risk? Why? Because at expiration, face value is guaranteed, right? You are not trading. I don't care. My bond price goes down in the middle of the holding period. I don't care. I'm not selling it off. At expiration, my face value is guaranteed. If issuer does not default, assuming most of the cases my face value is guaranteed, so there is no price risk. Price risk is always there if you want to trade, if you want to liquidate your position. Interest rate went up, the price will go down. Long-term bonds have more price risk than short-term bonds. Why? If the bond is for 10 years versus 3 years, it is way possible interest will fluctuate a lot. It is way possible you have to trade, you have to sell off, right? And there is one other reason why long-term bonds have higher price risk than short-term bonds. Company could also default, but that's not price risk, that is default risk. If the company default, that is default risk. But the most important reason why long-term bond has higher price risk than short-term bond is coming from the present value relationship. Because bond value is a function of present value of coupon, present value of face value, right? If it's a 10-year bond, you'll get the face value at year 10, right? If it's a 3-year bond, you're going to get the present value at face value at year 3. If interest rate goes up, the money you're getting at the long time will have more effect, right? From the present value relationship, if you're receiving money far late, will be more affected if you're receiving money tomorrow, right? Due to interest rate fluctuations. So that's why long-term bonds have more price risk than short-term bonds. Interest will definitely fluctuate way more because of long-term period. And the second important reason, a chunk of the money, the lump sum, present value, future face value, will be way for. If you discount it back today, it will be affected more. But if your borrower fail to pay at expiration, that is different. Low coupon rate bonds have more price risk than high coupon rate bonds. Why? If you look here carefully, value is a function of present value of coupon, present value of lump sum, right? And if you look carefully, value of any bond has more weight coming from present value of face value, right? Because it has the lump sum money. So when the coupon rate is really, really low, this weight goes up. Think about this way. One bond paying you 1% coupon, another bond paying you 10% coupon. Same face value. If you want to discount then that, find the value of the bond. Look at the ratio of your cash flow. Lower coupon bond value has more weight on the present value of face value. As a result, interest rate fluctuates. This is going to be more affected. So that's why low coupon rate bonds have more price risk than high coupon rate bonds. Questions about price risk. What is that? Where it is coming from? Why you should be concerned about price risk? In small sentence, if the price of your bond goes down due to interest rate fluctuations, that is price risk. Second thing, from the time value of money chapters, we learned that we always reinvest, right? If we generate any cash flow from the project before the end, we're gonna reinvest, right? We'll not go to the McDonald's and buy the burger. So that's why any coupon here should be reinvested. This coupon should be reinvested for 2 years. This coupon should be reinvested for 1 year. No reinvestment here, right? Because my project length is 3 years, right? Now, if interest rate goes up, we know that price will be affected. If interest rate goes down on the market, what does it mean? If interest rate goes down, all this coupon will be reinvested at a lower rate, right? Do you think it's going to affect our return or not? Definitely, right? So the second risk coming from is reinvestment risk. Because the idea is, if we make any investment in the bond, which we're going to generate coupon periodically, we'll keep reinvesting those coupons on the market. If market is really, really low, all of our investments from the coupon will be also low. And that's going to affect our total return. So if interest rate goes down, we have reinvestment risk. Short-term bonds have more reinvestment risk than long-term bonds. The reason is, if you invest for very short term, interest rate goes down, it is highly possible that interest rate will not go up to the normal levels by your investment horizon. As a result, you have to keep reinvesting all those coupon rewards. On the other hand, if you invest for a long-term period, you have more time so that interest rate can go back to the normal level and you can reinvest it. High coupon rate bonds have more reinvestment risk than low coupon rate bonds. Absolutely makes sense. High coupon rate bond means you will generate more absolute cash flow, right? Low coupon rate bond means you will be generating low absolute cash flow, right? If interest rate is low, the more you reinvest has more risk, right? Questions? Price risk, reinvestment risk. Good so far? Let's do that. It's very easy. You're buying a bond and into maturity is changing. What is the impact on your price? Yes,
Actually, those are chapter steps. Is there anything in specific we should focus on with the study for the quiz, because it's our longest chapter?
let's go through the. Let's go through it. Yes, I cannot remember what I put on it.
It's more than happy to be a couple minutes below.
But I can remember, so I know. Very easy from last class, right? Semi-annual coupon, right? So what should be the n then? Okay. 1 second. Face value 1000. What is our initial rate of return? Current rate of like yield to maturity? 6%. Then what should be the value here? 3. It's an annual. Payment. 5% coupon. Semi-annual payment 50 or 25. Present value. Present value. How much present value you got? Yes, Gabby. 915. Is it a discount, premium, or value bond? Is it discount bond, premium bond, or par value bond? Discount bond, right? Now redo the same process, only changing this one. Because what if interest rate went up? Redo the same process by only changing 6.5% from 6. What is the new present value? Yes. It's 7634. Because new rate of return is 3.25, right? So the price changes. Price change is basically 876.34 minus 91532 divided by 91532, right? Right? So price basically dropped by 4.26%. Interest rate went by 0.5% absolute term, but price dropped by relatively 4.26%. This is the price risk we have. Make sense? Now we are moving on how to calculate yield. Most of the cases when you talk about yield, bond has mostly two different types of yield. One is called yield to maturity or Y2M, and the other is called current yield. Yield to maturity is nothing but buy the bond today for the entire period. What is the rate of return you are generating? On the financial calculator, you need to find out this input. That's it. From the time value of money class, when you input all information, compute the rate or I over Y, this is a yield to maturity. Let's do this one. How much yield you find for this bond? Done. Who wants to volunteer? How much you got? What is the aim for this problem? Only payment. Face value or future value. 1,000. Present value. Rate of return or yield to maturity. Yeah,
8%.
8%. How much you find on the calculator? 4%. Then why 8% is the right result? Absolutely. The 4% you're getting on the calculator is a periodic rate, semi-annual rate of return, right? But we know that we have to show the result in terms of APR. So 8%. Make sense? You're getting different number?
No, I think we need to.
Error because you may not hit negative there.
Oh, I.
Present value should be negative, payment, whichever should be positive. That is the reason for error. Because that's a non-human instrument. It doesn't understand the difference between negative and positive. Any questions? It's basically a time value of money problem we did on the last chapter. Only the wording is different. Let's do this problem. Done. Okay. See from behind. Done. Why you got stuck? Right?
I got stuck on the payment part.
Why? So like we don't know how to calculate coupon rate, that's a problem. Or like, okay, let's see. Clayton, done.
That's checking, but I'm not sure what.
Okay, let's see Maddie.
We calculate the average distribution and the amount of percentage of the units.
Absolutely. Calculate payment first. Are we able to calculate payment from all of the information?
Yeah.
If we know the payment divided by face value. So basically, semi-annual or annual? Annual, so it's even easy. Calculate the payment first, so now tell me what is the payment you find? 6440, so how much is in? 12, rate of return 3.5, 1000, 12, 84, 10, 64, 40. This is a payment, right? Formula is on top. Right, so 64 divided by 1000, so coupon rate 6440 divided by 1000, so it should be 6.44%, right? Right? Makes sense. Nothing new. Now we can do it. Find the payment and we know the formula. Job is easy because it's annual, okay? If it was not annual, then you have to multiply by 2 or whatever is the frequency, right? If it was semi-annual, multiply by 2. Questions so far? Current yield. This is the formula. Annual coupon divided by current price. Don't get confused. Even if semi-annual compounding, you have to find the total annual coupon in absolute value. Total annual coupon in absolute value divided by current price. Let's say corporations pay $20 semi-annual coupon. Your annual coupon is $40, right? Total annual coupon in absolute value divided by price. Look at this example. 10% coupon, semi-annual payment, face value 1000. Current price 1197. If this is the thing, our annual coupon 10% on 1000 is $100 divided by price. Very simple. Total annual coupon divided by current price. That's the current yield. Make sense? We know that how to calculate coupon, right? Price will be given, or you can easily calculate the price, right? So this theorem is not only applicable to bond price, but it is applicable to almost all investment properties. If you can remember from the last class, we are trying to tell you, if we know the rate of return of certain investments, we can use the same rate of return to discount other projects having similar characteristics, right? So if we know the yield to maturity of a bond, then if we find another similar bond ready to issue, we can use the existing yield to maturity to value the new bond. This is the bond pricing theorem. We already went over this slide at the beginning of the class, but just a refresher. If you buy a bond, you will not get ownership interest, right? If you buy equity, you'll get ownership interest, right? Bond do not have voting rights. Common stock holders have voting rights. If you buy preferred stock, do you have voting rights? Only common stockholders have voting rights. Interest is a cost of business. It's a fixed cost of business. If you issue debt, if you are the company, You have to pay interest each year or each period. Fixed cost, doesn't matter. You're doing well, doesn't matter, you're doing poor. You have to pay it. Interest is tax deductible. Do you understand what is that? Interest is tax deductible. Why do you get a credit? So basically, if you can remember from income statement, EBIT, from that interest, taxable income. We always pay tax on taxable income, right? Or did you see that? Interest is deducted before tax is paid. So if you have interest, that means you will have lower taxable income rather than if you have no interest. You will pay less amount of tax. That's why it is called tax deductibility, yes.
Is that because the other person, when they receive the money, is gonna pay taxes on that money?
No. I really don't know the reasons. Ask your accounting professor. Because even if dividend is not tax deductible, but the other person who received dividend as an investor also pay tax. Make sense? Dividend are not considered a cost of business. Why? Because end of the year, if you think you're not doing well, or end of the year, if you think you need money for investment, you can keep all of the income, right? You are not obligated to pay fixed dividend to the common stockholder every year. You are not obligated. If you do, that's a good policy, but you are not obligated as a corporation. So that's why dividends are not considered a cost of business and are not tax deductible. Are not tax deductible because after we pay tax from here, we got net income. Dividend is basically paid from there, right? Make sense? Creditors have legal recourse. That means if as a corporations you don't pay interest, they can file for bankruptcy. That's a fixed obligation. You have to. You cannot miss the payment. Dividends are not a liability, and stockholders have no legal recourse. Even if corporations do not pay any dividend, doesn't matter. Stockholders cannot go for bankruptcy. Excess debt can lead to financial distress and bankruptcy. And all equity fund cannot go to bankruptcy merely due to debt since it has no debt. So basically, if you have a lot of debt, that can lead you to bankruptcy because debt comes with interest payment. If you are not able to pay interest payment, they can file bankruptcy, which is not true for equity holders. One point that is not added here, during bankruptcy, debt will be paid before equity. If there is a bankruptcy and the corporations have not sufficient money to pay debt and equity, debt will be paid before, then whatever left. Make sense? Bond indenture. You can think about it's a legal agreement between the investors and the borrowers of all terms and conditions. Right? if you buy anything, you see that in the contract, it's written terms and conditions apply, right? We never read the terms and conditions. You can think about the terms and conditions between investors and the bond. Basic terms of bonds like maturity, how many years, coupon rate, face value, semi-annual or annual payment, something like that. Basic terms. Total amount of bonds issued. Let's say corporate want to issue 1,000 unit of bond, face value 1,000. That means they want to issue 1 million, right? So how much total money they want to issue? Because there is a signal to the bondholder. Because given the company size, whether they're issuing a lot of money or less money, it's a signal to the investors. Description of property used as security applicable, which is called collateral. Let's say the corporation is telling that I have a plant, I have a land, I am using that property as a collateral for bond issue. That means if corporation defaulted, that property will be sold, payment the money. Corporations can also declare, I am not putting any property or land or whatever as a collateral for this debt issuance. Make sense? So that means if the corporation default, their main business will be sold, pay back the money because they have not used any specific asset as a collateral. If they have used any specific asset, that asset will be sold. Make sense? Sinking fund provisions. Any idea? Sinking fund. It's not something like that gonna be 200 words. So sinking fund provision means we know that if any corporations issue a bond, periodically they only pay interest, right? Coupon. At expiration, they pay the face value of the loan value, right? Which is a lump sum, huge amount of money, right? There is a possibility that at expirations, the corporations may not have that huge chunk of money. It may default. There is a possibility. To reduce the probability of that default, sometimes corporations create a fund and they show that each year or each period, they will put some money on that fund, which will be used at expirations to pay the loan. It is nothing but just reducing the probability of default at expirations. Because let's say face value 1,000 for 5 years. If the company decided each year they will put $100 on the sinking fund, end of 5 years, they're gonna have $500 already in the sinking fund, and they will need only more $500 to pay back the bond, right? Even if they default, borrower will get 50% of the investments. So reducing the probability of default. This is called sinking fund provisions. Call provision. Any idea? Call provisions. Simple, like calling it back, like the way we make a call on the phone. Call provision means we know that over the years, interest rate fluctuates, right? Company decided to pay you 5% coupon rate when they issue the bond. 2 years later, market rate is 1%. Company decided at issuance 5% coupon rate. 2 years later, market rate is 1%. Company paying more or less. more, right? Because 2 years later, company can issue bonds at 1%, right? So they are paying 4% more, right? So if they attach the call provisions during the bond issuance, that means during the period, they can call back all those existing bonds. They will call back all those existing bonds. Company can issue new bonds here at 1%. Using the money, they can call back whatever they should pay. But they are only allowed to do so if they have included call provisions.
How often are
I should say 5%, 10%. Yeah, they come with call provisions, yes. Because when market is really fluctuating, it makes sense to add call provisions. Why should I pay 5% when I can do 1%, right? Protective covenants. Sometimes investors want to restrict the hands of corporate owners. Because we know that what is the objective of corporate managers? What is the objective of corporate? Maximize shareholders' wealth, right? Right? So corporate managers will work for stockholders, right? They may not work for the bondholders, right? So sometimes investors, bond investors want to restrict corporate managers. This is called protective covenants. If investors add any terms and conditions so that corporate managers are not allowed to do some activities, protective covenants. Let's say bond investors included, you cannot pay more than 2% of your net income for dividend. Hypothetically, they added, you cannot pay more than that much of dividend. Protective covenants. Because if corporations do not pay a lot of dividends, rather keep the money within the firm, that money can be used next year for interest payment, right? So they're actually reducing freedom of corporate managers. Questions? There are a lot of different types of bond, registered versus BRL. So in a registered bond, your information, owner information is already printed on the document. BRL bond, it's not. Right? You can think about account paycheck or cash check. Do you know what is an account paycheck or is a cash check? So cash check is all about I write a check. Whoever have this can go to the bank and cash it. Make sense? Let's say I write it for, let's say, Isaac, but I did not make it account pay. Isaac can go to the bank, cash it. Even he can tell some of his friends go to the bank and cash it. But if I make it account pay, that means Isaac has to have an account in the bank to cash it. So it's more about owner information is registered. That owner can get the benefit, coupons and all of the money. This is what it is. Collateral, we already talked about that, right? Some sort of security. Mortgage, some sort of security. When there is a bond without any collateral, this is also known as debenture. Debentures will never come with any collateral or asset backed. Sometimes, if corporations issue two similar sort of debt, they have to declare which one is similar. Because in times of default, senior bond will be paid before junior. So they just have to declare. My bond A is senior, my bond B is junior. But they could be exactly similar. At default bond A will be paid default bond. Questions? Now, when a corporations issue bonds, they have to pay more coupon or investors need more rate of return if the bond is more risky. Okay? If I tell you there are two bonds, bond A and bond B, you have to find one which one is more risky. The riskier bond should earn more returns. From problem one, what do you think? Which one is more risky? Secured or debenture? Debenture, because it's not backed by collateral, right? So out of these two, debenture should earn more returns. Or the issuer, borrower should pay more coupon for the debenture. Problem two, what do you think? Subordinated means junior, okay? Subordinate means junior. Which one is more risky? Right, this is more risky. To earn more return. Why callable is more risky? Callable is more risky because investors will raise higher return, right? They will lose the higher return, right? Because corporations will only call the bond when the market is lower. So if as a corporations, I told you bond maturity is 5 years, you're kind of sure for the next 5 years, I'm generating 5% coupon rate, right? But market rate goes down to 1%, I'm calling off all my bonds. You get the money, but you have to reinvest at a lower rate, right? So you're losing return. So for investor perspective, this is more risky. For in borrower perspective, this is better, right? So they're buying a good bond here. So bond rating is similar to any kind of credit rating. So I recommend go to these websites, okay? Moody's and S&P. If you just Google, you can easily find them. S&P credit ratings. Can you guys read it? But do you think it's gonna open on the new tab?
No, not open like that. It's below that. If you right click it and then work down link 6, or just open image in the tab, down one more.
More.
Yeah, up one.
This one?
Yeah.
Oh, thank you. It's
You
still
can make
the
it bigger though with.
Okay. So go to their website, just but image quality is really, really bad.
I didn't say it was great.
So just look at like what is a high grade, what is a low grade. So the bottom line is high grade bonds are safe and secure. Should earn lower return. Low grade bonds are more default. Low grade bonds are more default. Should earn higher. Safe bonds, risky bonds. Now you decide where to go. Safe bonds or risky bonds. Okay. So one final information. in general, if you compare different bonds, first of all, you have to compare in terms of the risk characteristics. If they're same in terms of risk nature, and you are ready to take that much of risk, your second job is to compare their return characteristics. For any given level of risk, always choose the bond that pays you higher return. Make sense? But one more dimension. Municipal bond, federal bond, both are considered very safe instruments. Very safe instruments. So you don't need to bother about risk characteristics. You can only look at their return characteristics, right? Whichever is giving you higher return, go for it. But the problem is, municipal bond, tax exempted. If you want 10% investing in municipal bond, you don't need to pay any tax. Federal bond is not taxed. If you have 10%, you have to give your marginal income tax rate, which you learn from class chapter 2, right? Tax rate are progressive, right? If you have interest from federal bond, you have to pay tax. Then how can you compare? Which one I should go? Let's say your tax rate is 30%. Should I go for federal bond? Similar risk, they are considered very safe, no risks there. Because municipal bond is backed by state government. Federal bond is backed by US treasuries or federal government, right? That's safe instruments.
Yes.
Why?
30%, 11%. 70% of 11% is less.
Absolutely. So the idea is, second dimension you have to consider is tax rate. Only municipal bond is tax exempt. If you compare two different corporate bonds, don't need to bother, both are taxable. If you compare federal bond with another federal bond, don't need to bother, both are taxable. But when municipal bond comes into play with someone else, corporate, federal, or something else, second dimensions, compare after tax basis. So that means 11% on federal bond is basically $7.7%, right? Your return is 7.7%, not 11%, which you're paying tax. For municipal, your return is 10%, you're not paying any tax. Always compare after tax basis if municipal bond could be a choice for your investment decisions. If not, both are taxable, you don't need to bother. Should be same, right? Higher return will be the best options. You look here, taxable bond has a yield of 8%, municipal bond has a yield of 6%. Apparently, it may look like taxable bond, 8%, right? But when you compare after tax basis, from the taxable bond, your net return is 5.6%, which is lower than the municipal bond. So the formula is after tax basis, formula after tax return is basically pre-tax return or interest rate times 1 minus tax. Compare after tax basis. Now you can decide who is better, municipal or the taxable one. So steps, First step, if you have multiple options, look at their risk characteristics. If they're similar in terms of risk, you can say, okay, they're identical. I'll choose which one is giving me high return. But if municipal bond is there, second step, consider after. Make sense? So that's all. We're finishing early. So enjoy spring break. See you after.